Hello, and welcome to the launch for OMFIF's Global Public Funds 2024 report. My name is Nikhil Sangani. I'm the Managing Director of OMFIF's Economic and Monetary Policy Institute and one of the authors of this year's report, alongside my colleagues Clive Forward and Yara Aziz. Thank you very much for joining us as we explore some of the key issues and investment strategies shaping the thoughts of the public pension funds and sovereign funds across the world. Now, OMFIF has been researching this topic, the investment strategies of public asset owners, for over the last 10 years. Our research started with the Global Public Investor, or GPI, report, where we explore the investment strategies of central bank reserve managers. In the past few years, we've had over 70 of them submit surveys to us to inform our reports, and this year's one launched in June earlier this year. Now, for this report, the Global Public Funds, or GPF for short, looks at the other side of the equation, the public pension funds and sovereign funds, which are a broader group and naturally have some variation within them, but are an important group that are of significant size that can help shape the outcome of global financial markets. Now, this year, the report is informed by the input of 28 funds globally, 17 of them through anonymous surveys, others through interviews or discussions with us at OMFIF. Altogether, these 28 funds that inform the report are worth over 6.5 trillion in assets under management, a significant portion. Now, for this group of investors, as with many others across the world, it's been a turbulent few years. Of course, we had the pandemic and the dislocation in supply chains, the surge in inflation and interest rates, and alongside all of this, growing geopolitical tensions, such as the war in Ukraine. Now, while these groups of public pension funds and sovereign funds are inherently long-term investors, they've had to adapt to this short-term macroeconomic volatility. Now, in many ways, these issues aren't over. If anything, politics is becoming even more unpredictable and more uncertain. Look at what's happening right now in Korea or France, for example. But stepping back, some of the volatility in global markets has generally subsided as inflation and interest rates have started to come down. So it appears that global public funds are now approaching new horizons, which is the title of our report this year, in which they can start to refocus back on the long term. Now, very shortly, you'll be hearing from my colleague Yara, who'll be presenting the key findings of the report, where one of the key messages is we generally see greater interest of these asset owners in private markets, some emerging markets, and green assets, exemplifying the look back towards the long term. Now, we will have an excellent panel to dig deeper into some of these discussion points. And for those of you in the audience, we'd welcome your input into this discussion. There's a chat box by the side where you can share any comments or questions that I'll try and feed into the discussion itself. I'd also like to thank our partners, Franklin Templeton and Neuberger Berman, for their support on this project, and to each of the 28 funds who contributed to this report. With that, I'll hand over to my colleague Yara, an economist at OMFIF, to take you through the key findings.
Hello, everyone, and thank you for joining us for the launch of our Global Public Funds report. My name is Yara Aziz, and I'm an economist at OMFIF. Over the past several months, my colleagues and I have been working on this report, and it's a pleasure to share the key findings with you today. This publication draws on surveys, discussions, and written contributions from 28 public pension and sovereign funds globally, including survey responses from 17 funds altogether, representing a combined AUM of $6.5 trillion. This publication also includes articles from industry experts and practitioners with additional insights drawn from our analysis of funds' annual reports. The fund is structured around three main focuses. The first chapter examines macro trend and investment strategies. The second chapter explores geographic allocations. And the third chapter delves into ESG and transition finance, linked to insights from OMFIF's Transition Finance Working Group report. This year's key finding is that global public funds are embracing new horizons, as with short-term macroeconomic volatility easing, they are refocusing on long-term opportunities. Over the next few minutes, I will walk you through what this entails. Building on macro trends, a key shift is the declining concern over inflation as a primary short-term investment driver. This chart illustrates the change. with the dark blue bars representing 2023 and the light blue bars representing 2024, showing the share of respondents in percentage. We see on the left-hand side that 57% of respondents identified global economic activity as the most important factor shaping their investment in 2024, up significantly from 38% in 2023. In contrast, inflation dropped sharply, falling from 50% in 2023 to just 14% in 2024, reflecting its reduced influence among the surveyed funds. In the middle of the chart, other factors such as monetary policy and geopolitics gained prominence, each being selected by 14% of respondents this year. Notably, no respondents chose public debt or climate change as their top concern. This shift shows that concerns about inflation have eased in the short term, allowing funds to refocus on other economic drivers. As we move to the next slide, there is a similar trend over long-term investment strategies. Looking ahead over the next 5 to 10 years, two key factors stand out as a dominant driver of investment strategies: technological change and equilibrium real interest rates, each selected by 29% of respondents as the most critical consideration for the long term. The donut chart visually represents these findings, with the dark blue and light blue segments corresponding to these top priorities. The other three categories, inflation, geopolitics, and demographic trends, are evenly distributed, with each gathering 14% of responses, as shown in purple, green, and yellow segments, respectively. This entails a significant drop in inflation, which was a major long-term concern flagged by roughly half of the respondents in our survey in 2022 and 2023. Beyond these primary factors, funds also recognize other long-term drivers. While not depicted in this chart, climate change was highlighted by many respondents as a secondary or tertiary factor rather than most important factor, with 57% acknowledging its broader significance. One respondent noted, "The biggest development in artificial intelligence and climate change will have huge implications for the investment environment." Now that we understand the macro concerns shaping long-term strategies, the next question is, how do these priorities translate into asset allocation intentions? A notable trend among public funds is the growing tilt towards private markets as they seek higher returns. In this chart, the dark blue bars represent respondents planning to increase allocations, light blue indicates maintaining current levels, purple shows those planning to decrease, and green reflects those not investing in a given asset class. At the top of the chart, we see a strong demand for private markets. For the third year in a row, we see infrastructure stands out as the most in-demand asset, with more than 50% of respondents planning to increase allocations. Beyond infrastructure, there is a clear appetite for private credit, public and unlisted equities, with over 40% of funds planning to increase their allocation in these areas. But another significant shift is away from fixed income and cash, as seen at the bottom of the chart. Corporate bonds and cash showed the sharpest decline. This broader trend reflects a growing risk appetite as funds prioritize higher returns over ensuring liquidity. Building on these trends in asset allocation, the next slide explores how geographic preferences are shifting. Generally, funds are evenly split in their views between developed and emerging markets. However, within emerging markets, India is in high demand. India clearly emerges as the leader, with 58% of respondents selecting it as the most attractive emerging market in 2024, up significantly from 38% in 2023. A representative from a major North American pension fund shared additional factors driving investments in India, including its demographic dividends, strong regulatory framework, and political stability. Other markets like Brazil, Mexico, and South Africa follow but remain in less demand. The most striking shift, however, is China, where its attractiveness has dropped dramatically from 23% in 2023 to 0% in 2024. We identify in the report major funds from Europe, Canada, the US, and APAC, which are now reducing their exposure to China, reflecting growing geopolitical risks and economic uncertainties in the country. In this context, India has firmly positioned itself as a bright prospect and is likely to attract increasing flows from global public funds in the coming years. Now, moving into the ESG section, let's start by exploring asset allocation trends in sustainable investments. This chart highlights public funds' plan for ESG investment over the next 12 to 24 months, with no respondents planning to decrease their ESG holdings. What stands out is the strong intention to increase allocations to private market within their sustainable portfolios, mirroring the trend we saw in general asset allocation earlier. At the top of the chart, we see over 60% of the respondents planning to increase their investment in green sustainable venture capital, private equity, and private debt, as reflected by the large dark blue segment. And half expect to increase their allocation to green real assets, such as real estate or infrastructure, in the next 2 years. By comparison, there is a muted demand for fixed income products, such as green bonds, especially when compared to our survey a year ago. This trend partly reflects a belief among funds that private investment allows them to achieve a greater impact compared to public equities and public debt. More than half of the funds stated that they can achieve the biggest impact on transition finance via unlisted equities. However, there are still critical barriers that public funds face in scaling transition finance, as we see on the next slide. This chart shows what funds selected as their top 3 most important challenges. The lack of commercially viable projects emerged as the most common barrier to implementing transition finance, identified as a top 3 concern for more than 70%. This highlights the difficulty funds face in identifying projects that align financial returns with sustainability goals. The second major barrier is an unclear policy environment. Without stable and supportive framework, public funds are hesitant to fully commit to transition finance investments. This suggests policymakers need to ensure that policies are aligned with market outcomes and provide incentives for investors, such as risk sharing and carbon prices. To conclude, public funds are embracing new horizons and can now prioritize higher long-term returns rather than navigate short-term macroeconomic volatility, and are planning to do so through greater investments in illiquid assets, particularly infrastructure. India has emerged as a top choice among emerging markets as funds reduce exposure to China due to geopolitical and economic concerns. Lastly, ESG investments are gaining momentum, with a strong emphasis on private markets and real assets, aligning sustainability goals and impact with robust financial returns. To wrap up, thank you all for your attention. This concludes my presentation. You can download the full report for additional insights and deeper analysis. Now I'll hand it over to begin the panel discussion, where we'll dive deeper into all the key findings.
Thank you, Yara. Over the next hour and 15 minutes, we'll be going over some of the discussion points that you've just heard of with an expert panel with 5 panelists who I'd like to welcome to turn on their cameras and join us for this discussion. Thank you all. So we have Jahangir Acker, Head of Official Institutions at Neuberger Berman, Timo Laitiniemi, CEO of the State Pension Fund of Finland, Keiko Honda, Adjunct Senior Research Scholar at the School of International and Public Affairs at Columbia University, and member of the United Nations Investment Management Committee, Pascal Lagarde, Executive Director of International Strategy, Research and Development at BPI France, and John Normand, the Head of Investment Strategy at Australian Super. Thank you all so much for joining us. Over the next hour and 15 minutes, we'll be looking into three of those main discussion points that comes out of our research on the macro environment, on asset allocation strategies, and finalizing on ESG. But for those of you in the audience, we'd encourage you to submit your questions throughout the next hour or so, and I'll pose the best ones to our panel. John, I'd like to start with you. One of the findings that we see is that concerns on inflation, at least in the long term, over a 5 to 10 year horizon, are easing amongst the public pension funds and sovereign funds that we surveyed this year. Concerns, or at least the strategies, are more based on technological change and equilibrium real interest rates. Does that resonate with you? How are you thinking of this issue at Australian Super?
It resonates with me to some extent, meaning some of the factors you mentioned are somewhat structural in nature and longer term. Some of them are slightly more cyclical, and I think depending on your investment horizon, you need to use both of those as grounding points for your investment asset allocation. So when I think about the cyclical concerns or the focus areas for the next year, it's around a few issues. One, is it pretty likely that the stable growth we're seeing at the headline level, meaning in aggregate when we look at global GDP, is that likely to be maintained? And I think it will be, even though there's quite a bit of imbalance between the US and Europe. There's quite a bit of imbalance between the US and China, and also there's quite a bit of imbalance between manufacturing and services. I think the US is benefiting from essentially pretty strong income growth and the likelihood of fiscal stimulus. I think of Europe as receiving some stability from this ongoing process of monetary easing, and China benefits short term from a process of twin monetary and fiscal easing. So I'm pretty comfortable with the idea that global growth is going to be around trend, even though there are reasons to be concerned underneath the hood. Inflation, I share the relief that it's come off the highs, but I have much more concern that it wouldn't take very much stimulus out of the US over the next year or so to have inflation firm up in a way that gets the Fed back into the game in a couple of years. So I would be more focused about
sorry to interrupt. So in what sense? Is that to say the Fed might start hiking rates, or is that to go on pause?
I wouldn't be surprised if the Fed started hiking again in 2 years if the US miscalibrates its degree of fiscal stimulus. And I think this is the key point that I'll leave on, since we have a number of speakers, is that there is a calibration problem in the US administration right now, where they've proposed a very ambitious fiscal program, which is twinned with a number of supply side measures that are also inflationary. So depending on how much they move on each of these fronts, how much they cut taxes, how much spending increases, the degree to which they find fiscal offsets, the degree to which they reduce the supply side of the economy through immigration restrictions or deportations, the breadth and the magnitude of the tariff restrictions, we could have an inflationary problem reemerge in a couple of years, or the economy could continue to deliver roughly trend growth and close enough to target inflation. If you believe that the policymaking community in the U.S. had enough foresight and enough political will to be able to calibrate that set of policy measures, then you shouldn't be that concerned at all about the outlook for growth assets and risky markets. But this is really imprecise stuff, even when you have very thoughtful and very well-intentioned policymakers at the helm. So while generally we're oriented towards a continuation of the expansion, we're oriented towards a moderate volatility environment. I think the scope for this to turn out in a much more adverse way in the next couple of years is still present. So I would be comfortable with foresight for the next 12 months, maybe 18. I'm more concerned over the 2-year horizon and slightly beyond.
Thank you. And Timo, to come to you on some of those points that John raised from a US perspective, if you share some of those longer term concerns and how you see things here in Europe, given that you're CEO of a Finnish fund and with exposure to you.
Yeah, certainly the focus has been in recent, let's say 6 months, has been refocusing from inflation to growth. Then the question is that how sensitive are the interest rates and monetary policies in relation to the growth prospects? Still, everyone is optimistic of the coming 1 and 2 years in terms of growth picking up, especially in Europe. Of course, Europe plays a different path than the US in many ways. And then regarding the equity market, the key question is that as long as the interest rate is a buffer or is balancing the act of the growth, it gives a justified basis for equity valuations. But of course, certain sectors like technology has overshooting. But then, of course, there are some other sectors which are very promising currently. For example, the defense sector is very promising for Europe, and it certainly gives some new opportunities. Then, in generally, I would say that investors need to be crisis sensitive in terms of how to react if there are events like energy price event, if there are any conflicts, if there are banking events. I think all of the investors should be having sufficient buffers for the coming years.
And just one quick follow-up on that. I mean, is there any one of those risks you mentioned on the crisis management that sticks out to you on the banking crisis or possible escalation in energy costs?
I think that most of the elements which are events and severe events are typically in terms of surprise events. But I would say that one most challenging factor is certainly the sovereign debt levels and the deficits which most countries, at least in the Western world, are facing. And that is certainly putting pressure in the coming 2 years' time to sovereign interest rates, and therefore the politicians really need to be carefully managing the balances in order not to create any crises going forward.
Thank you. Jahangir, any reflections on what we've heard from John and Timo there on some of the macro risks in the next few years?
Yeah, look, I thank you for having me today. I do agree with John that I think the inflation has moved to a structural model. And I think the inflation levels that we'd become accustomed to, the lower levels, are probably that resigned to the past now. I think one of the points that I'd like to raise is particularly forward-looking with a structural shift away from globalization, which has been arguably deflationary over the last 30 years, to a much more regionalized or localized model of supply chain and production and labor workforce and manufacturing. We are going to see and then you see in the developed world, particularly the UK, the US, minimum wages increase, fiscal stimulus has come through for different programs. I think you'll see a higher base level of inflation over the next few years by virtue of the change of global markets and structures. That probably links me to my other big concern as we think about the way capital is being allocated. Emerging markets certainly seem to be struggling. The number of conversations I have with central banks and other, public sector investors from emerging markets is, sorry, it's really not you, it's the US. There's not much they can do to prop up their currencies to get their, one would argue, the competitiveness, but the reality is the next phase of tariffs are going to further strengthen the US domestic or the dollar, as we've seen from remarks this weekend as well. That does create some fundamental issues about the future of emerging markets, and we do see developed market investors kind of trimming back, if not completely removing their EM equity and EM debt allocations. We see this natural overweight of investment opportunities, but also investment dollars then going to the US, and I think these are things that will continue to change the shape of the way investors are asset allocating, but also the shape of capital markets. I think we see this globally at the moment, wherever you are. Nobody can get a listing or a capital market liquidity going other than in the US at the moment, even something like the London market struggling with liquidity. This concentration into one geography, I think, has the potential to create some real strains.
Thank you. Yeah, I think we'll come on to the emerging market point shortly. It reminds me of a discussion we had at OMFIF earlier this year, where representative from an emerging market central bank essentially said that it's the advanced economies that aren't playing by the textbook right now, where the emerging world and many of the major emerging markets, at least, they've been restrained on the fiscal sides. They have kept real rates in positive territory by and large, and that hasn't played out in many of the advanced economies like the US, and if anything, emerging markets are suffering for that. So yeah, it's an interesting point. Just one quick follow-up on your side, Jahangir. I mean, it's been about 10 minutes into the discussion and I've not heard the word Trump mentioned yet. I wondered if you think that with the new administration coming in, if you still see that trend of capital flowing into the US, if you still see that continuing.
Well, I kind of referenced it with the tweet this weekend. So you can give me half a point for that.
Sure.
Look, absolutely. I think the cabinet that he's putting together, the agenda that he's putting together, the leadership that we're seeing, potentially to many scary leadership that's emerging from the world's richest man. But what does that do? And I think people are sort of sitting there and saying, well, what investment opportunities are going to get created from this drive for efficiency, this push to AI, this technology push? So I think there is, and then the markets seem to be loving it at the moment, right? I mean, they continue to be volatility, but positive direction. So yeah, no, I do think that this doubles down, and with tariffs, manufacturing onshore will definitely look like an area. Now, Mexico in Trump 1.0 was a significant beneficiary. Does Mexico benefit in 2.0, or does it actually now move into the US itself? I think that's yet to be seen. But as long as that sort of old NAFTA region benefits, I think the US wins.
Okay, yeah, thank you. Pascal, I'd like to come to you sort of on a related point that you oversee some of the international strategy for BPI France and how you're seeing some of the risks in the global economy, and whether, well, so we're seeing some volatility in France itself, and you may want to comment on that as part of it too.
Well, maybe a few words about volatility in France. I mean, it's very strange for us because we have always had a very stable government for 50 years now. So compared to a lot of countries around the world, we were like changing parties, but very stable. So that's very new for us, but it's linked to a very strange parliament right now with 3 blocks, which have no, there is no possible majority. So that and no dissolution possible before July. So we'll see. So and it has, of course, an impact on the economy and even internally, not only I would say ratings or that kind of stuff, but we made a survey a few weeks ago with SME entrepreneurs, and their level of confidence for the future was at the same level it was just after COVID, first phase of COVID, sorry. So it's, politics is maybe close to COVID, so it's very interesting. But I want to stress 2 things about geographical and geopolitics. I think Donald Trump's policy may strengthen some things, but I've got the feeling that on the external policy, tariffs will have a kind of an impact, especially on Canadian and Mexican products, and that may rush some change in production centers, like was said before, and but it may have an impact also in Europe, especially in Germany. I think Germany may be a big loser of that because of its strength in industry and in export, especially in automotive. Deregulation is also a very important stuff, and it may create 2 things. It may encourage investment and give a competitive advantage on the US, but it will create also a big discrepancy between Europe and US, because more and more US providers won't be able to cope with European regulations, and that will be a strange position. And of course, that will create higher volatility on exchange rates at the end. I would stress another subject would be, which is China. We didn't speak a lot about China, but I think China is a big unknown in the coming months and years, because we have a stimulus right now, okay. Is it enough to change a lot what happened in China with infrastructure and real estate? Not sure. And I'm not sure on this side of no. And the second thing is with Donald Trump coming, there is no way that U.S. restrictions won't be tightened, and that may change a lot because that would mean one of the big direction the Chinese economy has taken during the last years, which was technology, will take a kind of a big stop, even if they are trying to replace some of the bricks, the elements they can't produce yet.
Yeah.
But it's a problem, I think, and that will be a disadvantage to a lot of countries which were exporters to China.
Mm-hmm. Yeah, thank you. That really helps to set the scene for a discussion point I'll come on to on China specifically. But maybe before we get into that, Keiko, I'd like to get your thoughts on how you're seeing this global economy picture from what Pascal was saying. It's maybe, and Jahangir making the point on maybe US continues to grow well, Europe and maybe China continuing to struggle a little bit. Is that how you're seeing things as well? Oh, sorry for you, Keiko.
Okay, well, thank you. Yes, I'm Japanese, but living in the US last 12 years, primarily in New York and DC. And then I do see that US has been booming. I think it will continue to be booming for 3 reasons. First of all, I think about $110 trillion money is professionally managed around the world, among which 45% in North America, and majority, of course, in the United States. So a lot of monies are locally here, and therefore, which is active. And second of all, a lot of innovation, which has been improving the productivity of the people, are originally developed and also further developed in here. I think, one theme is AI. Nobody really talked about it today, but I think that's a big theme. And also semiconductor rising from the AI boom it's also kind of seeing. But having said that, this election will give an impact, possibly positively, possibly negatively. So, we have to kind of watch very carefully. As John mentioned, the new administration could impose tax, which may have impact on the inflation. If it's happening, people may see higher and longer for interest rate. But I think another thing I just kind of want to mention is the sovereign debt issue, which I think Timo mentioned, or if I'm very wrong, please correct me. I actually have a little bit of concern for the sovereign debt. The reason is the following. During the World Bank and IMF annual meeting, sovereign credit issue are the usually prominent topic of the discussion. While these discussions typically focus on developing nations, but this October, the subject was France. Notably, France's credit default swap spread were almost identical to those of Italy, despite the France holding a double A minus rating from the S&P compared to Italy's triple B rating. So therefore, but I think also another thing I just kind of like to mention, if we look at last 40 to 50 years, not only France, but the United States government primary spending as a percentage of the GDP has been increasing significantly. So this trend, if we continue, I think we have to be very, very careful sovereign debt for the next several years.
Yeah, thank you. John, maybe coming to you on that point, is that something that you're worried about, is the fiscal trajectories of US and some other European countries?
Absolutely. I think the debt sustainability issue has already shown its ability to impact the bond markets and DMs pretty significantly, albeit over a short time period, meaning a quarter or two, when we've had episodes where a country which has exhibited a large level of indebtedness, debt to GDP over 100%, when it's also been carrying a large fiscal deficit for 5-6% of GDP. And when a government injects uncertainty into the fiscal path, either through a change in government or a proposal to pursue unfunded tax cuts, the bond market reaction has been pretty severe. And we saw this several years ago in Italy after an election in 2018. We saw it obviously with the Truss government in the UK in 2022. We've seen it in France over the past few months. And I think because the US shares a lot of sovereign credit features and ambitious fiscal policy features with those governments, I have it as kind of a base case that you're going to see one of these highball bond market events in the US over the next year. The only thing that would avoid that would be a pretty unambitious fiscal program out of the US Treasury. And even though the Treasury is run by someone who should have a sensitivity to those issues, we need to acknowledge that fiscal policy is not going to be solely proposed as a function of what the Treasury Secretary thinks or the head of the National Economic Council thinks. It's also going to be a function of what the president himself thinks. And this is where you have to say that maybe the balance of risk is towards an overreach initially in terms of the fiscal program, an adverse reaction in the bond market, and then a recalibration of that program to something that's more digestible by the bond market. This is also why I wouldn't change anything around broad investment strategy towards equities, towards private markets, on the assumption that there'll be a bond market spike or a bond yield spike. It's simply recognizing that when that volatility event occurs, it will likely cause drawdown in markets for investors who have been looking to add to that exposure. That's an opportunity to add because fiscal officials, Treasury officials will dial back their ambitions in response to the feedback loop from the market. So it's really a message about volatility as opposed to a game changer around fiscal policy. I just don't think, I think any administration in any country is capable of learning from the feedback loop from the markets. We've seen this in many countries, and I think the US will follow those learnings too.
Yeah, interesting. And I think that helps to answer a question that we just had come through on the chat box about what one of the negative implications of the US election might be. We've also had it in a more global context as well. I do wonder if one of the lessons there as well, I mean, just thinking on the UK case in particular, is that it was ultimately the Bank of England who stepped in to sort of help with the gilt market here. Obviously, there's the various different toolkits that the ECB has been trying to deploy to protect some of the blowout in sovereign spreads in the periphery countries here. I wonder if by extension, it's something that it might be the Fed steps in that case.
Well, I think an important difference between the UK and other countries is the existence of the liability-driven investment dynamic, and that how that drove sort of a fire sale of safe assets and the extraordinary move up in bond yields. That the US doesn't have that sort of structural feature in terms of the pension base, so it's less vulnerable from that perspective. And obviously, anytime there's a sovereign debt issue in the euro area, there's always this question around the degree to which the ECB will step in, since it's not supposed to be the financer of governments. So I think these structural differences are important for thinking about how much the bond market would spike or how much yields would spike. I tend to think the spike in the US would be smaller than what we've seen in Europe. It would still be a multi-sigma event. And if the move is 50 basis points in a quarter, that's not something that would cause the Fed to get involved. I'm not even sure 100 basis points would get the Fed involved, at least not the current Fed chair.
Yeah, noted. If Timo could maybe come to you on the point on emerging markets that we've just heard in particular, which you mentioned, sorry, I think Pascal mentioned initially that some of the concerns over China. Jahangir mentioned that some of the emerging markets are struggling to attract capital right now, given the global conditions. How are you seeing those trends between the allocation towards developed markets to emerging markets right now?
Yeah, I think internally, at least in our organization, what we have recently discussed is the definition of emerging market. That what does it really mean to have a country which is an emerging market? There are certainly some countries which are should be defined as developed markets already, China as an example of that. And therefore investors have a bit of question mark that where are we investing? But still, having said that, emerging market as a concept and also as an index covers all various continents. So in that regard, the emerging market is still the right word in our understanding. Interesting to hear that right now in this survey there was a enthusiasm about India, and certainly the population growth is certainly supporting the growth of India, because population growth is one of the key ingredients for economic growth, and therefore it's not directly linked to equity returns. So one has to be careful there in order not to take that for granted, because there's always this PE function or price to earnings function, which has which is a factor to play with, and certainly if markets are very much overshooting, then there's a risk of just from the financial market point and equity market point of view. So that one has to be careful with.
Yeah, thank you. And it was interesting. We had a contribution in the report itself from PIC, the South African pension fund, and their CIO, which mentioned that they see relative valuations as relatively supportive to emerging markets as a whole, at least compared to the US. I don't know, Jahangir, if that's a view you subscribe to.
Absolutely.
Yeah.
I think, sorry, Timo, go ahead.
Yeah, go ahead. Yes.
Yeah, no, Nikhil, I would say absolutely. I think we see undervaluation or value opportunity in different businesses, industries, sectors across the emerging markets, whether it's Latin America, whether you see that in African corporates and businesses. The problem is, on the other side of it, people are not finding the risk reward to deploy that capital. One of the other challenges for a lot of the players on this call is to be able to enter those markets which are perceived as politically complex, legally complex. You first need to have a significant level of scale in the transactions that you do. So one of the things that I'm hearing, particularly in Africa and LATAM at the moment, is the deals aren't big enough for the big investors to go into to try and create that movement, and the small ones aren't big enough to create all the work to do that and analyze that and figure out the political connectivity that you need to create long-term protection. So there are balances and challenges there. So absolutely see value opportunity there, but I want to link that back to a comment that was made earlier. Unfortunately, the emerging markets, equity particularly, the stock exchanges have not reflected the opportunities that exist in the GDP of the economies. They are not sufficiently diversified that they reflect the growth and the opportunities that emerge in their domestic markets. That's been a challenge over the last decade plus for people to actually participate in the GDP growth or the growth broadly of emerging markets, and that's frustrated investors a little bit. But emerging market debt, the debt has certainly been in a more attractive way, and we see, again, opportunity and value opportunity, particularly in the hard currency space. Local currency is difficult, again, going back to the dollar strength.
And this one, oh, sorry, go on, Pascal.
Yeah, a few words about our own experience in the especially in Africa, because we've been investors in Africa for a long time on the PE and now VC market, private equity and VC market. I agree with the fact that public markets in Africa are very, very shouldn't touch that. But PE is a little different because it's private equity, so you can have a certain liquidity because there are a lot of scale-ups, and more and more these nice mid-cap companies are becoming regional. So it's no more one country; it's a different countries. So you mitigate the risk, the political risk. And that's very important. And there is a big trend of consolidation. What we do in Africa, we never invest directly. We invest through funds, private equity funds. We know the market. We've been there for decades, and they are becoming to be very professional. So they can elect the, let's say, 0.01% of companies which are the fastest growing. And why are they fast growing? Because the economies are themselves very fast growing in fact, and the needs of the population are huge, and they are producing more and more capability of buying equipments, buying stuff and like and services. So it's
That's
working
fantastic.
quite
Are
well.
there any particular sectors that you're looking at in that VC space in Africa?
Oh yeah. On private equity, most of the time it's around agro-food. Agro-food is very nice. Health, finance. Finance is a good market. Telecoms used to be very, very good. I think it's no more. And on VC, everything which is linked to IT. IT is very good because they are developing some very good products which are adapted to that kind of population.
Yeah, well, thank you. I think it brings us nicely into one of the key points that we raised in the report more generally about the interest in private markets, particularly on infrastructure, but also in private credit and private equity too. Over 40% of those we surveyed said they're looking to increase their allocation on that front. And Keiko, I was wondering, from your perspective, any initial reactions to that, and if you think that makes sense to you, given where we are in the global cycle or in financial markets more broadly right now.
Well, thank you. I think I actually agree with the survey that you conducted. A lot of pension funds, as well as some of the insurance company, actually probably don't really think about how much liquidity they really, really need. And then allocated a relatively large portion of money into the asset class, which provides high liquidity, but probably not higher returns. So therefore, I recently moderated the webinar of the Columbia University, where we have two ladies from pension funds. One is from the public pension, another one is from the UN pension. The public pension lady mentioned that they allocated 60% of the AUM in the private assets, while UN pension now allocated about 16%, 1/6. But they kind of want to increase. So that's the point I just like to mention. Of course, not across the asset class. Developed market or G7 pensions more allocated into private equity historically, although now I think they're a little bit of overweight since private equity performed slightly more than other asset class. So therefore they are facing the, how often, how well they have to rebalance that portfolio. I have some opinion about it, but I'm not really mentioning it here. I think another thing that I kind of seeing, if you talk about the developing or emerging market, I think one asset class I just want to mention is the infrastructure. Infrastructure, this is the one like a GDP growth, a population growth is more reflected. In addition, a lot of public money going in as to kind of enable investors to enjoy the branded finance.
Mm-hmm. Yeah, thank you. And that's a big focus in what some of my colleagues have worked on in the Sustainable Policy Institute in a recent report they did on transition finance and how blended finance can be a solution on that. And perhaps we'll get onto that shortly. John, I wonder if I can come to you. I was reading Australian Super's annual report, which came out recently, where there's a line in here that unlisted assets are expected to outperform listed equivalents over the medium to longer term. I was wondering if you could provide a bit more context to that, and if that's a view you still hold.
It is a view we still hold, and the degree to which we believe that does vary by particular unlisted market for various asset class specific reasons. So if I just kind of start with the more maybe conservative side of unlisteds and work to the more riskier parts of it, I think about private credit returns versus public credit returns is very much related to the spread that they're offering as a premium over the public market equivalent. And even though that spread has come down from the cycle highs a couple of years ago, it's still reasonable. It probably pays 200 basis points more than leveraged loans, and leveraged loans pay about 150 basis points or so more than high yield credit. So if you believe that we're at a phase of the business cycle over the next couple of years where defaults are going to be contained because earnings growth is decent, then it would make sense to be more allocated to private credit than to leverage loans or to public credit, assuming that fits within your liquidity constraints or liquidity needs. So that's something very particular around the relative all-in yields in these different parts of the public and private credit markets, and also it reflects a reasonably benign view of the default cycle going forward. If I think about infrastructure, I agree with the comments that Keiko made, and I think it also links into some of the comments that other speakers have made about the upward bias on, or the structurally higher level of inflation that we're facing that always is going to argue for being in assets that have some link to inflation, either direct as a pass-through kind of pricing mechanism, or because they're quite geared towards nominal GDP and nominal earnings, and infrastructure fits with that. I think of infrastructure as having the additional advantage in that it is a way to get pretty direct access to some of the thematics that long-term investors are very focused on, whether that's AI and technological disruption, which can be played through the digital space, or whether it's through clean energy for those who are quite focused on the energy transition. So even between those two, sub-asset classes of alternatives, the infrastructure space and the private credit space, there are different sort of factors, but they all kind of lead you to the same conclusion, which is that there's an opportunity there, which is probably better than the opportunity in public markets right now. And then finally, with private equity, which is the riskiest and the highest return of all of those, we tend to think of them as offering higher earnings growth over the very long term because of the ability of PE to essentially drive operational efficiency improvements in these markets. And really the big question is there better value in the private credit markets or the private equity markets versus the public equity markets? At least in the US, where the public equity markets are quite expensive, whether you look at the market as a whole, whether you look at particular sectors like technology, or even more vanilla cyclicals like financials and industrials, PE has derated and it hasn't re-rated in the same way or to nearly the degree that the public markets have. So if you think there's a long-term case for private equity related to the operational improvement that one can translate into higher earnings, and you recognize that the valuations are more attractive, I still think this is the place where higher returns are going to be earned relative to the public markets.
Yeah, it's an interesting point there, and actually just on the interplay between private markets and technology, I'd encourage the audience to download the reports. We have an article written by Winston Ma, who's a professor at NYU and former senior representative of China Investment Corporation, who wrote an article about that exact topic on AI and where many of the biggest sovereign funds are investing right now through things like data centers. Jahangir, I just want to come to you now on pick up some of what John mentioned about the opportunities in private equity in particular, and that's something that features in the article you co-authored with a few of your colleagues at Neuberger Berman, which features in the report as well. And where you see the opportunities in private markets right now.
Yeah, look, I think the opportunity is definitely, as John describes it, it's in the liquidity premium that you're getting the pickup on. I think as private credit continues to gain momentum, as people want that extra pickup in fixed income, there's lots of academic articles and naysayers at the moment, even about the value out of private equity. I think in both cases, you have to look at the beta of the market, right? And the beta of the market, particularly in the private markets, whether that's private credit or private equity, and it's more pronounced in private equity, is around the dispersion of returns between the top performers, the median, and as a result, the bottom performers as well. And so where we end up in an environment like now, where returns are looking more challenged in the short to mid-term in private equity, it becomes even more important, as we've noticed over the last 10, 15, 20 years, at thinking about how do you construct that. You construct that through your core beta allocation, and that maybe there are interesting new ways of creating that beta allocation and a private equity or a private credit, and those may be the guys who are building portfolios through auctions or more broad stream, large scale allocators of capital. But then it becomes the satellite, the alpha generators, and there are still, and in fact, in this environment, I'd say there's an even greater leaning towards the dispersion of returns to the top decile. The best quality of deals, ironically, in the private markets go to the biggest or the most active or the most connected players. That's just the nature of the private markets, which means the outsized returns and the alphas are going to be coming out of your sort of more exclusive, more selective managers. So ironically, I'd say for the last 10 years, manager selection has probably not been that important in private equity. You could give your money to any private equity GP and they've done quite well. I think in now what's happening is you're seeing the best performing managers getting better origination of deal flow, whether that's on the credit side or on the equity side. And as a result of that, their ability to continue to raise capital in the LP market do very well.
Yeah.
Now, without a plug for Neuberger, we're seeing that opportunity in two areas of liquidity creation, right? So that's in secondaries through the traditional LP secondaries, which is buying positions from existing investors, but actually the emergence of the continuation vehicles or GP-led secondaries. We've been doing this for about a decade, but that's about taking great companies that structurally are being forced to be sold because of the tenor of a life of a fund comes to an end, but they're just great companies that private equity funds want to hold on to. So we help that continuation vehicle. It seems illogical that anyone gets forced to sell great companies they own. No, they want to continue owning them.
Yeah.
And then the other area is similar to that, which is the co-underwriting or the midlife co-investing deals, which are similar construct to that. So sorry for taking time, but those are the areas we continue to allocate to.
And that I saw both Pascal and Keiko nodding along as you were speaking. I wonder if Keiko, you wanted to come in on some of what Jahangir's just mentioned, and I'll go to Pascal after that.
Yes, maybe a few words about mainly private equity, I think, and venture capital. First, the rise of private equity in sovereign wealth funds and pension funds has been during these past years huge. In fact, there has been a huge increase in percentage and in amounts, and in two ways, by the way, and mainly by doing direct investments for most of them. There used to be GP selection, so fund of fund, like you said, but now it's also direct investment. It used to be direct co-investment, and now it's also direct investment. So you have fund of fund, direct co-investment, and direct investment. And most of these people, they have, of these institutions, they have created some teams by hiring people and by creating their own teams of PE, VC, and fund of fund. So it's quite interesting. What are the sectors which are targeted? I think there is a move away from more volatile cyclical sectors like consumer goods, software, and you are more and more focusing on big trends like sustainability. So that's very clear. It's a huge market. Renewable energy, green technologies, ESG. Technological innovations like artificial intelligence, but also cybersecurity, which is big now. And of course, since COVID, there has been a big trend on healthcare and biotech. So that are on PE the big trends. Venture capital, since 2 years, the market is not that good, but it's very strange. I mean, it's not that good, but on the other side, you have very huge fundraising rounds. And in these very huge fundraising rounds, you see sovereign wealth funds direct. For example, if we take Mistral in France, which is very nice and promising AI companies. You have lots of sovereign wealth funds which did the last round, including the PIF from Saudi. So it's quite interesting to see that there is a shift in this.
Yeah.
What infrastructure?
I could maybe sorry, if I could maybe bring Keiko in on one of those points, maybe we can come back to you afterwards, Pascal. But it was particularly the point on the interest in sustainability, which is, I know, an area that you look into quite closely, Keiko. And if you could maybe share your thoughts on that interplay between ESG investment and private markets, which is another big theme that comes out of our survey as well this year.
Yes, I think United States, because of the President-elect Trump, less interested in climate change. So therefore, a lot of people think like ESG is dead. I do not think so for the both public as well as private market. I can give you one interesting example. The premium of the US home insurance, which include the fire and flood insurance, has increased by 33% between 2020 and 2023. And of course, P&C insurance company have the best data of occurrence of those climate events, as well as how much damage that a policyholder actually suffered. That's why they can price the insurance. So this fact, by the way, this was actually appeared on the paper Professor Keyes of the Wharton School wrote this fall. So, the government may make some comments, but at the same time, I think, the private investors or even public investors like us have to understand what is the real risk. So therefore, I don't really kind of agree every single ESG risk have to be reflected into the investment, but any material factors of ESG which directly impact either mid or long term of the financial statement of the company have to be identified, have to be disclosed. So therefore, asset manager and asset owner have to make a very smart decision.
Yeah, thank you. And just Timo, I'd like to come on to you on that point and how you're thinking about ESG in your portfolio. But very quickly, I'd just like to remind the audience to please continue submitting any questions you may have that I can pitch to our five panelists here. But yeah, Timo, to you on ESG.
Yeah, so if I tie that to private markets a little bit, just to kick off, in our infrastructure portfolio, we have a new renewable energies as one of the focus areas, and certainly wind energy has been one of the key elements. What we find there and also elsewhere in ESG is that, first of all, there was a peak in ESG investing 2 years ago. So, and that was driven by a hype cycle, just like an ICT partly can be explained, the hype in terms of pricing of all ESG related assets. Secondly, it was the interest rate, which was at the lowest 2021. And that certainly gave an element for all new innovations in this field to be priced heavily. Of course, there has been a lot of things happening since then. Energy transition has taken place in Europe in record time. So there has been a huge transition in terms of energy away from fossil energies sources and gas towards renewables. So there has been a lot of things happening. Regarding the ESG strategy, in our case, we are quite pragmatic. We have been focusing on the climate change as the key ingredient and the key metrics what we are focusing, meaning that we are looking at carbon intensity and the company level and the portfolio level as one of the key metrics, and therefore we have been trying to reduce the carbon intensity of our portfolio, especially in the equity side, and in fixed income, it's a bit different. And in private side, we are just, let's say, we have just started to monitor that and to see how the private managers are reporting on carbon intensity, and that's going to be the work which is still going to continue. Overall, we are very satisfied in terms of the metrics what we are receiving from consultants. and we can follow the carbon intensity quite well, and we are in terms of achieving all our targets in terms of reductions. In terms of strategy development, I think there's globally, I would say that there's a bit of pause right now in terms of new developments. And there has been a heavy regulation, at least in Europe, regarding ESG in general. And I think there is an atmosphere of a bit of pause, waiting for government policies to follow up and to really work on their commitments. And of course, geopolitics is also impacting the priorities of investors and also the governments. So, but I'm very confident that in years to come, of course, the ESG, climate change being also the world waters as a new area possibly. So I think there certainly are elements which are coming up again, but certainly these last 2 years has been a rewriting of some of the strategies.
Yeah, and actually just one very quick follow-up on that. You mentioned that you're mainly looking to implement this on the public equity side. Is that in practical terms, is that by divesting from certain, say, oil and gas companies, or how are you looking to achieve net zero on that side of your portfolio?
Yeah, it comes from different elements, but I think the main element is that we are betting on normal companies to reduce their carbon intensity. So we can be a passive index investor and still reaching some of our goals. So I think it's good to confess that that is the key strategy going forward. But then we have introduced, over 1 year ago, we introduced a so-called ESG transition portfolio, which means that we invest in managers or in funds which are investing in brown and gray industries and companies and turning them into clean. So I think that's absolutely an element which I saw also in the survey actually, and which was pinpointed in the survey. And I fully agree with that strategy, and we are implementing that. So since last year we started that, and we are continuing to expand that portfolio.
Yeah, no, thank you. And as I mentioned before, it's a key point of work that our Sustainable Policy Institute is doing, and produced a report on that just a few weeks ago at COP29 in Baku. So for those particularly interested in that topic, please go. I'd encourage you to go read that report. But I mean, it's still relevant to this discussion as well. And Pascal, I'm interested in how you, from perspective of BPI France, you're looking at implementing ESG into your portfolio.
Well, I fully concur with a lot of what Timo said. I mean, there used to be a few years ago, climate action, which is a big part of ESG, was to invest in, let's say, renewable energies. And then you said, okay, I did my job. And that's no more the case. I mean, you still have to invest in renewable energies, but the big thing is transitioning companies from gray or brown to green. And that needs a lot of investment, but it's also a premium at the end, because these companies will be able to have a better competitive positioning in the future. So it's something which is quite interesting. And also, we were also able to issue green bonds as BPI France. So that's the other side of the story. And we issued 3 green bonds, and our third green bond was 1 billion euros, and it was on renewable energy projects. And we also issued a social bond on promotion of entrepreneurship and in disadvantaged areas, and that's also something quite new. And I was about sovereign wealth funds and ESG. One thing I wanted to say is most of the sovereign wealth funds and most of the pension funds, which we have representative here, are very keen on ESG, and they don't really care about what their governments say. And they are quite independent of that. And I was at the beginning of the week in a meeting with UpSwift, which is a big congregation, a big organization of sovereign wealth funds, which is chaired now by His Excellency Al Rumayyan, the chairman of the PIF, of the Public Investment Fund in Saudi. And when you look at the ESG strategy of PIF, it's impressive. It's really impressive. And most of these very large sovereign funds around the world, that's what they are doing. And they are also emitting green bonds, and they are rated by international agencies to see what's the level of their commitment of what they do. So I think it's a big trend. There may be some fluctuations, but the coming of Mr.
Direction
Trump
is clear,
won't
yeah.
change anything to that. Anything.
No, interesting point there. And actually, we've got a follow-up question on that, which Jahangir, I think I'll pose to you, is how does transitioning from grey to green support a more competitive position? Which I think I'd interpret that as, is it compatible with, I guess, the fiduciary duties of many public pension funds to deliver returns, or likewise on the sovereign side, by supporting the transition while still maintaining sort of good returns?
So the way to think about it is total return equals quant plus qualitative, right? So those are the drivers of your return, and there can be qualitative value add and there can be quant value add, and that's your total absolute return. So if you believe in the world of efficiencies and capital market efficiencies, if you weigh up more qualitative returns, then what's ended up happening is your quant returns have come down a little bit. Some of that is driven from we have been pricing or mispricing things that actually are part of the ecosystem, right? Air, water, and all of those things. And we've been pricing them at zero. And now all of a sudden, if you try and run a well-run company, you value that asset better. Unfortunately, that has resulted in having compression of returns. So when we run our strategic asset allocation with a climate change tilt in it, we do see about a 28 to 30 basis points. So most people approach ESG from a bottom-up perspective, but it's actually important also to start approaching it from a top-down perspective. How does it tilt your portfolio at a strategic asset allocation if you incorporate strategic asset climate change requirements into it? And it does create compression of 28 to 30 basis points in terms of the absolute return. So when you end up in an environment where your forward-looking capital market assumptions are compressed, your public market return expectations over the next few years are expected to be lower, your private equity returns, while still high, are lower than where they've been for the last decade or so, you kind of sort of say, well, as a pension fund manager, can I afford to provide my pensioners 28 to 30 basis points less return? The challenge we're getting from folks is no, because the fulfillment of my liability is so deeply important that I need to deliver on that pension return. And that is creating some dichotomy, because you see in the wealth market that people were in the DC market, you could even say, saying, I want more sustainable product. What's happening in the DB market is, and in social security systems, is people are saying, well, can I figure out how I do good for the world whilst generating the disproportionate returns? No, you've just been mispricing water and climate. And now, I'm sorry, but you got to pay a price and a fee for no longer damaging that. And there is a little compression there. So that's possibly not what people want to hear. But I think we'd got to a point where we were valuing qualitative ad. And it feels right now that people are having to go back to a quant focus.
Yeah, it's a useful point. And I think it feeds into a broader finding that we see in the survey this year, that one of the biggest hurdles to implementing transition finance in the portfolios of the public asset owners is the lack of commercially viable projects that they see, and maybe it doesn't hit the returns profile that they're looking for. If Keiko, if I could come back to you and thinking more in terms of the barrier side, and what do you see, or what do you think are the biggest hurdles to implementing ESG in the portfolios of some of these big global investors?
I really don't see the barrier if for the, for the investors who has been working on ESG single materiality side, I don't see any obstacles. We definitely have to pick, but climate is not the only one. For example, I think paying the appropriate level of tax, which is one of the major ESG factors, also having a proper cybersecurity measures in financial institutions, that's also proper and a proper ESG investing. I think, none of the, when it comes to those things, I really don't see any problem arising from the newly creating even US administration. But when it comes to like a double materiality, I think it will be challenged, as everybody's saying, even in Europe.
Yeah, no, thank you. And again, we're heading into the last 15 minutes of the discussion here, so yeah, encourage the questions to keep coming in on that front. If I can maybe change tack slightly and come to John, and what we've heard is climate change is maybe one area that, at least from some of the analysis that Jahangir is making, that they've running some of the models and seeing what it might mean for portfolios. Are there any ways that Australian Super, there's some of these top-down factors that you're looking to stress test your own portfolio, and if it's climate change or any others that you're trying to see as some of the big risks right now?
We definitely incorporate ESG at a security selection and a security valuation level. But when I think about it from the asset allocation level, I think it's reasonably easy to draw a line between the climate change and the climate transition issue and some of the macro variables, because the pace of the transition and the distribution of that transition across different countries does impact rates of inflation, volatility of inflation, balance of payments positions of certain countries, return on capital in various countries. And so we had that as an overlay in terms of thinking about whether or not we are inadvertently taking on some exposures we wouldn't want in a world that is transitioning to net zero over the long term. So that's one area. I'd say the other major theme that we incorporate, which is not so much risk, we think of it more as opportunity, and probably most people think of it as opportunity as well, is just technological disruption and the AI theme and all the winners and losers that creates within asset classes and across countries. So the answer is yes, we definitely look at this. Sometimes the bulk of the impact comes in valuing individual securities, but for some of these themes, there's definitely an implication for winners and losers at the asset class and the country level.
Yeah, and if one quick follow-up to that is there was, and I think you mentioned it previously, that some of the areas where that does look attractive is when you go look back in the private market space. Coming back to one of the contributions that we had for this report from PIC was, and I'm paraphrasing here, but it was essentially saying that they don't think that the run-up in US tech stocks is justified, or it needs further justification. Is that your sense as well, that maybe this surge in the S&P 500 or the 5 mega stocks has gone a bit too far?
I agree with that. I don't think there's signs of excess when you look at country level valuations, index level valuations, or sector level valuations. I'm sure there is excess when you look at some individual stocks, but at the asset allocation level, we tend to focus on sectors and countries. And the reason I don't really characterize these as excess is because the PEs relative to the long-term average are lower in tech than they are in bank stocks, and they're lower than they were during the dot-com bubble, but they're also occurring, meaning the high multiples are occurring at a time when profits growth is still quite robust. So I think of that as quite different from the situation in the late 1990s, where high PEs were persisting in an environment of shrinking profit margins and decelerating profits growth. And that was also occurring after a period of quite excessive and multi-year investment in capex and IP spend. And so if a country has been undergoing several years of above trend growth in capex, general investment spending, and IP specific spending, and the companies that are engaging that capex are not generating a high return on investment, then you can say that's excess. But those different sort of variables don't line up in that sort of worrisome way yet. If you're looking at sectors, if you're looking at mega cap names and if you're looking at the US economy as a whole. So things are rich. There is optimism, which is quite broad, but I wouldn't use the B word, i.e. bubble, to describe, what's going on here broadly.
Yeah, and then thank you. And similar question to you, Timo. I know a big part of your portfolios in listed equities, and presumably a lot of that is focused in the US right now, and how you're seeing that part of your portfolio.
Yeah, of course, the future estimations or forecasting in terms of equities is very hard to do. We rely on long-term risk premiums, which we think historically has been in a nice levels. And of course, the future, most probably it will be a bit compressed, taking the valuations, especially in the US. The US valuations for tech industry there's a warning signal for investors. Whether that's warning is a false warning or whether it's a right justified warning, we shall see, because the earnings development will be determining factor. There may be overshooting by market participants, and I was referring to this hype cycle, which is the Gartner consultant concept from the .com bubble. And of course, the overshooting may happen when there is a lot of enthusiasm of a theme, and certainly we have that in place. But it's really the earnings which are then the determining factor whether these pricing levels are justified or not. But certainly it will be at least some of the experts which have been looking at now, coming year and years to come, possibly 7 to 10 years. Of course, there are two camps. One camp is that AI is giving us a significant economical growth boost, and the other camp is saying that because of the current valuation levels, the expected returns on equities may be slightly compressed.
Mm-hmm. Yeah. We've just got a question come through about the top destination for emerging market investments. Then again, it was one of the key points that came out of our research is that there's a lot more interest in India this year, which Timo, you referenced earlier. Jahangir, you said that there's some interest. It's a difficult time for EMs generally, but there's some interest in EM on the local currency or hard currency side. Sorry, but how are you thinking about this on a country level and that finding on India in particular as a top choice for the funds we've spoken to?
Look, I think it's a slightly difficult one because India is everyone's hot flavor at the moment, and part of the reason is because once you do a strategic asset allocation to EM, you've then got to within that decide which one of the 56 countries you get, and if you're EM ex China, you don't have much left. I've had some fun conversations with clients where they've wanted me to build them an Asia ex China correlation strategy. At which point it's like, how do you do that? So people are really clutching. India has definitely been a beneficiary of that, and they've certainly got a lot of momentum behind that. But I don't think anyone can take away the Adani effect. The Adani has re-highlighted the risks of doing business in India. Some would argue the risks of doing business more broadly in emerging markets, but I think it is unique to India in this instance. And I think that's raised concerns for a number of folks again. So the emerging market story isn't holding that exciting at the moment in my mind, particularly in the equity side. But on the debt side, you get paid a premium for that. You get that cash pickup. And that's where the hard currency becomes so attractive because you get that pickup, but not on but you don't get some of the risk participation that you get on, or the lack of reward you get on EM equity at the moment.
Mm-hmm. And yeah, thanks for that. And Pascal, I know you mentioned Africa previously. Are there any other emerging markets, regions or countries that you see as interesting right now? I'm sorry, you're on mute, Pascal.
Sorry. We invest in Africa, not the rest of the emerging countries. So I don't have any foresight on that.
Yeah, noted. And maybe Keiko, I know in your previous experience with the World Bank, you must have a lot of experience in operating or investing in emerging markets, and how you're thinking of that, the opportunities and risks there right now.
Well, of course, there is a risk as as I just mentioned, I think, the governance level is typically a little bit looser than that of the G7 country for sure. But at the same time, opportunity, as I mentioned, the British finance. I think not only UN, World Bank, IMF, as well as all developed nations continue to, governments continue to support the developing country one way or the other. But I think they are not necessarily putting their own money in form of the debt or in form of the grant. Rather, they like to leverage private expertise. So therefore, how to kind of leverage those opportunities to mitigate risks and also, gaining enough attentions from the local government of the emerging markets is definitely the key. I think there is a good benefit. I can just give you one example. During those infrastructure financing, I didn't really see much. I see a lot of commercial banks such as Citibank, Standard Chartered, and so forth, and also French banks and Japanese banks. But I didn't see much activity. JP Morgan 5 years ago, but last 5 years, JP Morgan changed strategy drastically. I see them in a lot of infrastructure financing, especially debt side in emerging markets.
Thank you. I'm conscious we're coming down to the last few minutes, and I think maybe one last and maybe slightly provocative question to ask each of you, and unfortunately I may only give you 30 seconds to answer this, is if in 12 months' time, when we come back to thinking about some of these questions again and for our surveying, which one asset class do you think will outperform over the next 12 months? If I could get a very quick 30-second answer from each of you, maybe Pascal to start us off on that.
I would think that in the long run, VC, which valuation went really down, except in AI, I would say, would be a winner.
Yep. Thank you. And John?
The next 12 months, I think it's US equities, but they're going to deliver half the returns in 25 that they've delivered in 24.
Okay. Thank you. And Timo?
It would be the equities, a diversified equity portfolio.
Jahangir, I appreciate the briefness so far from the three of you.
Has to be co-investing or secondaries in the private equity space.
And is there a particular sector within that or country?
Well, private equity is overweight US, so it's the US.
Yeah, and Keiko?
Short-term US equity, but a medium-term private equity.
Right. Thank you very much. Well, I think in one way, shape or form, that's about 3, if not 4 votes on US assets in one way, shape or form, which maybe comes back to my first question, one of my first questions, that maybe the President Trump and the new administration won't have a huge bearing on markets, at least in the very short term, although it remains to be seen on that front. Thank you very much to the 5 panelists here, for Timo, Jahangir, John, Pascal, and Keiko, for your insights. And thank you all for tuning in. I think there's been quite a few points that has been raised in the past hour and a half, on not just on our report, but in this discussion. I think we've heard that well, on the macro side, it's still a difficult situation, but at least in the next 12 to 24 months, it seems that US growth is likely to outperform. Geopolitics remains a bit tense, and there's a few countries, the likes of Canada and Mexico, that may suffer in that environment. Likewise here in Europe. On asset classes, it seems like there's been a general consensus that private markets, at least over the long term, is the way to go, and maybe in the short term, US equities is still the safe spot, and in emerging markets, natural risks, but still maybe some opportunities there. And lastly, on ESG, it seems like that's a key focus for the 5 of you that has been mentioned here. For those of you who'd like to find out more details about what we've just heard here and from the key findings presentation, I'd please encourage you all to download the report that you can find on our website, and as I referenced before as well, the transition finance report that we just launched a month ago. But thank you all for joining us, and thank you to our 5 panelists again. We hope to continue engaging in these discussions very soon. Thank you.